Okay, hello everybody. Welcome. It is Cinco de Mayo, May 5th, and I wanted to give a quick update. The Federal Reserve came out last Thursday with some updates to its Main Street lending program, and there are 5 key considerations that everyone needs to be aware of here. It's a bit complex. They've now got 3 different lending options. The thing you need to know about it above everything else is this is probably something you need to look into. It's very inexpensive money, and it's being run through your bank. Banks are getting geared up to start lending on this. I've talked to a number of banks, and they're going to be able to start lending on this anywhere from a week from now to 2 weeks from now. So now is the time to get started on this. On our website at tgg-accounting.com, we have a bank organizer for this Main Street loan program. I would encourage you all to get there, download it, get your stuff in there and get ready, because it's going to be a lot like the PPP, and that once it opens up, the funds are going to go pretty quickly. So you want to make sure you're in the front of the line and that you're prepared. Now, what changed? In the original, there were a number of different restrictions about loan sizes, about dividends and distributions, about EBITDA questions. I'm going to try to demystify that for you in the next couple of minutes. So there were 5 major changes that happened. The first major change is that highly levered companies or companies with existing debt can now actually go into this program. Before, you couldn't go in unless you had more than, you had to have less than 4 times debt to EBITDA ratio. Now you can actually go into more debt than that if you're a solid company, but the bank is going to have to take on more of the risk. Before, the bank actually took on only 5% of the principal risk. Now they're going to have to take on up to 15%, so 3 times as much risk for the banks. So they're going to be a little more cautious in lending to you if you have that sort of a situation, but it does open it up. So that's a really good thing. The second thing that they did is they made this open to eligible companies of larger sizes, so all the way up to $2.5 billion in revenue. That doesn't impact a lot of you who are watching this today, but I just wanted you to know that that's out there. The third thing that they did is they reduced the loan size from a minimum of $1 million. They took it down to a minimum of $500,000. This is a really big plus. And the reason this is a big plus is because now at 4 times EBITDA, that's only $125,000 in EBITDA to get to that. And if you're a highly levered company, again, you can get into these loans but the banks are going to, again, have a little bit more scrutiny on what you're doing. The fourth thing that they did, which is important, is they redefined EBITDA. It seems like EBITDA should be easy to understand: earnings before interest, taxes, depreciation, and amortization. But there are all sorts of things that small companies do that banks allow, like add backs for sort of owner's compensation or excessive compensation or a car allowance or things like that get added back. So what the Fed did is they said, listen, we'll allow the definition of EBITDA to be the existing definition that you've got at your banks. And again, that's a really good thing, because now you just go to your bank and your bank will tell you whether or not you qualify for their EBITDA definition. You don't have to somehow fit into something that's different than what you've done in the past with that bank. So that's good. The fifth and final thing, which is a really big thing for small business owners with pass-through. This is LLCs, S corporations, things like that. If you're like me and you take tax distributions out on a quarterly basis, but you only take enough so that you can pay your taxes and you're not taking distributions for yourself, they said that's fine, but you have to take the distributions out to pay tax, not distributions out to pay yourself. So it's a very important distinction. And that's a big change for them that allows a lot of business owners that were concerned about, well, how do I pay my taxes in this? That gives them some relief from that. So again, lots of complication here. I'm not going into all of it, but the key thing that you need to be aware of is that this is a great loan opportunity. Again, the terms are the same. You still got these 4-year terms with a year deferred, interest rates anywhere from 2 3/4 to 4%. Lots of opportunity here for you if you need that cash to be able to use it towards just about anything. But again, the main focus of it is to try to keep people employed and to try to keep your business moving forward. So if you want to take advantage of this, again, I would encourage you to go to our website at tgg-accounting.com, download that Main Street Organizer, make sure you've got that available to you so that when the banks open up and start taking applications, you're at the front of the line with all of your stuff organized. Hopefully this was helpful to you. If you have any questions, you can also email us directly at info@tgg-accounting.com, and we'll hope to see you soon. If there's any other updates, I'll bring them to you as soon as we got them. Thanks again for listening. Talk to you later.